All right, everyone. I think we'll jump on and get going here. Uh, Welcome to the Market Review and Ideas. Brian Overby, Senior Options Strategist here, filling in for Tony Zhang, the Chief Options Strategist. And before we get too far along, I have to let you know that options involve risk. They're not suitable for all investors. Before trading options, you should read characteristics and risks of standardized options. It's available to you on almost every single page of the Firstrade website. And if you need a hard copy, please ask them for it. They'll be happy to send it to you. I'm going to look at a few trades that are not meant to be recommendations. Past performance is not a guarantee of future results. And you always want to check with your financial advisors to make sure that these strategies are relevant to your trading in your portfolio. Okay, my name is Brian Overby, and we have, today a lot going on. To be kind of blunt about it, the marketplace is looking at the news about the Fed and the if the Fed can remain independent, the challenges there. So there's a little bit of battle between the Fed and the current administration. And the market kind of shook that off yesterday. So I don't know if they really think that it is a threat, a true threat to be worried about. But we have the December inflation coming out today. It should be coming out at any second right now. And that is going to be a big number as far as determining if the Fed is willing to cut rates going forward. Inflation is one of the mandates, and trying to keep that tame is a big number. So today is a big number, not to mention the fact that we had JP Morgan announce earnings. There's a little bit of trepidation in the earnings report. The stock is kind of flat on after the earnings report. They beat on the bottom line, but not on the top line. Revenue was a little rough, but the stock is not getting beaten up, and neither is the market. The market is still hanging in there, still fairly flat. Tony did add a couple of, or a stock, I should say, to the research report, which is XYZ, and we'll look at that stock right now, but ideally, I like to go in and take a picture or look at the earnings that are coming up. So we had JP Morgan, and that goes hand in hand with Goldman Sachs. And I've mentioned a couple of times in the financial space that I do like the financials. I like the way the yield curve is going. We're seeing the shorter term interest rates come down. Now a lot will weigh in on obviously the next Fed meeting, and we're seeing longer term interest rates start to creep up. So the lower interest rates in the short term aren't necessarily creating a lower interest rates in the long term. This is good for the banks. And you've seen this recently. Citibank or Citigroup is going to be announcing two here shortly. And we got BlackRock that's going to be announcing. A lot of these are the deal-making stocks. BlackRock and Goldman Sachs, I think, are two of the stocks that can benefit from the 2026 expansion of deals. Investment banking firms, they got their hands in everything as far as mergers and acquisitions are concerned. So I want to get long Goldman Sachs. JP Morgan was a little bit muted today on their earnings report, but I want to try to look at a trade today to set up to get, now this is a speculative trade, to get long Goldman Sachs going into their earnings report. And the other stock that we're wanted to look at was Block Incorporated Software. This came out today. Tony highlighted that XYZ recently broke out above its 67.5 resistance level, outperforming the S&P 500. It's a recent pullback to this level and provides support for opportunity for our upside target to 82. Now, see, Block has been on and off the research report a few times, but it's always done solidly in the fundamental space. So always just the biggest thing is looking for the opportunity on the chart, and we're seeing that. So this is a stock that earnings don't come out until February. 38 days away. You still have some time before you get to that earnings report. But our forward PE trading below the industry average, the expected revenue growth above, expected earnings per share above, net margins above. So just a very well-run company across the board, showing some weakness recently. And a lot of the software companies have experienced some of this weakness, but we see this as a buying opportunity going forward. All right, so I want to focus on Goldman Sachs, and if you have any other questions, I do see a question in the Q&A box asking about the quantum computer sector. Well, I guess exactly what type of companies are you looking at in the quantum computing sector is more of a question overall. Obviously, AI is a big part of this, of everything that's going on in 2026. There are a couple of ETFs in this sector that I think would be interesting, because trying to guess exactly what company might succeed in the space on a lot of the lower cap companies is kind of tough. There is an ETF, Quantum Defiance ETF, QTUM, which holds a lot of these companies in the space. And I think if I'm going to stick with something and I want to speculate on the quantum computing sector, and I'm looking at the smaller cap companies in the space, I think I'd rather stick with an ETF and see how it would do overall. But the way that I would approach quantum computing sector this year, I do think the path of least resistance is to the upside. But there will obviously be volatility in this space as news comes out. Every day we get more news. People are worried about the spending. The stock, all the stocks in the space go down. Then people are worried that people aren't spending enough, or that companies aren't spending enough. And then eventually, then that has a tendency to drive stocks forward. People can't decide exactly what they want to do in that space. So I guess that would be my approach to them. We don't have any smaller cap stocks. I mean, I guess if you want to talk about the big caps, Google is one of the people making headway in the AI space. They got beat up first for their policy, and now they are doing well, and you could make them in that quantum computing sector too. But yeah, Alphabet or Google, I think, is probably one of the best ones in the space. And then you can look at Microsoft, and then obviously you have NVIDIA, who is the leader of it across the board. And we have NVIDIA on our research page here too. 184 is where it's at. It's kind of gotten beaten up, a little bit of a period of consolidation here, but still solid forward PE relative to other stocks in the space. Expected revenue, expected growth have always exceeded the marketplace relative, and usually in their earnings reports, they usually have a tendency to beat both the top and bottom line. So NVIDIA is still a strong number, and I think that you can buy on the weakness. Okay. Let's escape here, and we're going to come back over here. And I want to talk about setting up a trade around earnings and how I like to trade around earnings. And I'm going to do that by looking at, where did it go to? Looking at Goldman Sachs. So let me grab Goldman. There it is. Ooh, for a second there, I thought I lost my website, but here we have it. Okay, back into the fold. Let's blow this up a little bit here. So if I'm trading based off of earnings, and that's the whole reason why I want to set up my earnings trade. I'm anticipating a top and bottom line beat. I'm anticipating that the underlying stock will act positive after earnings. I always like to try to, oh shoot, we just lost the numbers in here. Take out the time premium as far as your option contract is concerned. And we have Goldman Sachs, which is announcing earnings on this Thursday before the open. But they just wiped out the quotes. So I guess I didn't anticipate. I don't do this webinar enough to know that this is going to happen. But let's go and see if we still have them inside the options wizard. See if we still have quotes sitting there. And I always like to straddle the market. I like to look at buying an in-the-money call option and selling an out-of-the-money call option. So in this instance, we have a call vertical spread is my preferred type of trade if I want to lean bullish. Now you can be speculative and say, okay, I'm looking at Goldman Sachs. I do think that there's some strong upside. Let's buy an out of the money call spread, a long call spread or a call debit spread or a vertical spread. The platform calls it as a vertical spread, paying a net debit for the trade. But I like to actually straddle the market when I want to make it just about the earnings report. And I like the fact that Goldman announces on a Thursday, we have all day Thursday and all day Friday, because it's an expensive underlying stock. $949 is where it closed at. And I'm going to modify this trade. Now, if you just want to get bullish, the platform usually is going to suggest a further out trade. You're going to be buying something at the money, selling something out of the money. Normally around a 20 delta is what the out of the money option contract is. You see here the 1070 strike call option on the upside, and it's trading at a 19 or a 17 delta at this point in time. So you're looking at selling something around the one standard deviation move on the upside, and then buying something that is close to where the option is at on the long option contract. So we're just a little bit in the money on the long option. And the platform has a tendency to draw those out. It's more of a longer term outlook on Goldman Sachs. If I'm going to trade based off of the earnings report on Thursday, then I want to look at I'm going to go 10 days out. You can go 3 days out. I don't mind doing the 3-day one, but I'm going to start with the 10-day one only because of exercise and assignment. Honestly, especially when I'm talking to a crowd of retail clients, you got to realize that in the short term, you might have an obligation to buy the underlying stock. And even though you are in control by doing a long spread, you still might have that. If you fall asleep by Friday and you don't close out the trade, that is going to be an issue. So I'm going to go out 10 days. Let the trade play out over the 10-day period. And look where the stock is at. We're going to go equidistant in or out of the money. And we're going to make this a fairly inexpensive trade. And we're just hoping that after the Goldman Sachs earnings, that we will get the move will be to the upside as opposed to the downside. And it's a all or nothing type trade. But I do like to point out the fact that you can remove the time premium in the option contract by trading this way. With the stock at 949, we're going to look at the 940s. So let's go in and buy the 940 strike and going out 10 days. And then we're going to go 10 points out of the money. We're going to buy the 960 strike on the upside. Here it is. And now you're not going to get a great options play score here because it's going to be a 50-50 bet. And a lot of this score is related to making sure that you have double or triple the upside relative to the actual downside. It's a risk reward scenario that you're looking at. Options play score of 83 isn't horrible. It's still in the yellow. It still means that it's a viable trade. But if we look at the trade here, we're going to almost always, we're a little bit on the downside here, but you're going to come close when you're doing these positions to making it a 50-50 bet, in that we are 20 points wide, and the midpoint for the trade, based off of where the markets are at right now, the markets are closed, is $11.28. So we're risking $1,228 to make $8.72. Now, that makes our break even at 940 plus 1128 if we can fill at the midpoint, which the markets are going to be very liquid because of the earnings report. And 940 plus 1128 is 951.28. And that's all the move that we need in the underlying by that expiration date is just a couple of points, and this trade would be at break even. Now, what happens when you straddle the marketplace is you are looking to buy almost as much time premium as you sell. So I'll say that again slower. You're looking to buy almost as much time premium as you sell. And if you get that, if you buy the same amount of time premium as you sell, then the break even is going to be very close to where the underlying stock is at right now. You're basically removing that headache that's involved in options trading, especially around earnings. So if implied volatility goes down on the one that you bought, which is hurting your position, it's also going down almost equally, right, on the one that you sold. It's not always a one-to-one basis, but it's usually fairly close, especially if you have the same amount of time premium. So if you want to get bullish on Goldman Sachs, very simple, straightforward trade. You're paying $1,128. You hope the stock stays where it's at or goes higher. We needed to get to 951.28, which is 1128 plus 940, the 940 strike. And that is, I guess that's the way that I would approach Goldman Sachs at this point in time, leaning into this earnings report. Now, deal-making stocks, and I do still think that 2026 is going to be a year of mergers and acquisitions. It's going to be a year of deals. And if you want to just get long Goldman Sachs, another way to approach it, and we talked a little bit about these type of trades on the last, I guess, review of the marketplace and trade ideas webinar that I did with Firstrade. And I would just wait for the earnings to come out. You're going to miss a potential opportunity. We got a fairly decent pop yesterday, but it's only 1% because it's a $1,000 stock. And look at buying deep in the money options as a surrogate for owning the stock. And I'd like to put together a little portfolio that kind of addresses some of the deep in the money option contracts. But as a longer term bull on Goldman Sachs, I would let earnings come out and then look at going out 6 months or longer in time and buying something that has around an 80 delta. Goldman is a very liquid underlying, and buying deep in the money option contracts, there is kind of an issue with bid-ask spreads, and that's always been an issue. If it wasn't for the battle with bid-ask spreads on deep in the money option contracts, I don't think I would. If they were as liquid as the stock, I don't think I would ever buy stocks. I would only buy deep in the money options. But it is a battle, and so sometimes it just makes sense to just buy the stock outright. So how do I approach that? Okay, we have this trade on, and this would be my strategy. If I like Goldman Sachs, which I've already mentioned that I do, and I'm heading into earnings, this is the trade that I would put in around earnings. I'd put this trade in and say, I do anticipate the market to go up after earnings, and I don't want to miss out on that opportunity. Let the earnings play out. If I do miss out, all right, well, I limited my risk. I'm not going to go overboard. My risk was $128. My reward on a one-by-one basis was $872. Now, I'm still staying in the 100 share space in my mindset. One by one, this obviously represents 100 shares of stock as far as this strategy is concerned. And then after the announcement, look to do a bull call trade. So here in this instance, I would go deeper in the money, go out to probably the June expiration. I think there's a June 18th expiration, half a year out in time. And then after the volatility came down, and you're going to have, increased vol because there will be another earnings season going in, but like to see the trend and see where the market is at, and then scroll down and look at buying an 80 delta option contract. The 840, they're both about 79.80. Even the 830 is there. Let's look at the 840. Now, if I'm buying this option contract, realize that it's still going to be a real option contract in that it's trading for $147. And this is what I mean by looking at the bid-ask spread. You got to kind of work this. But the trade cost is going to be $14,735. Now, that's going to come off a little bit because you do got some vol premium even going all the way out to the 156 days away, the June 18th expiration. So it should be on a relative basis without looking at the move of the underlying. It still should be a little bit lower cost than where it's currently at on a vol premium basis. But if you're talking if you bought the stock outright, you're looking at $94,955 to buy 100 shares of Goldman Sachs. $14,735 gives you real good stock representation. You obviously got to pay some time premium for it, but you're going to get a delta of 80, meaning that this is going to act something like 80 shares of stock. And the total percentage of the $94,955 is 15%. So what does that mean? The maximum you could lose is 15% on the stock. And the way that I always approach it if I'm long an option contract is like this. I don't want to allow myself to lose that entire 15%. So if the stock ever comes down to the strike, which is the 840 strike, I want to get out of it. Or I would say to myself, if this position gets cut in half, I'm going to get out of it. And so I'm looking to lose about 7 or 8% on the stock. And if I'm right, well, on the upside, I usually like to adjust the position if we get to an 80 delta or to a 1 delta. In other words, you're way deep into money and the underlying stock is now trading with a delta of 1, meaning that for every dollar that the stock goes up, the underlying option contract will go up 1. And it doesn't mean that I'm done. It just means when it gets to that level, I'm way deep in the money. I don't want to get in any more illiquid on the option contracts. And I'm going to roll to another 80 delta option. So might go out a little further in time, take some of the profits on the current option trade and roll it to another option trade if I'm still bullish on Goldman Sachs. And in that instance, roll down to an 80 delta, and that would be a cheaper option contract. And that's the way that I like to position myself on these high price underlying stocks that I want to get bullish on. Any questions on that? All right. All right. So Citigroup is a different underlying that I also like. I think Citi is announcing it on the 14th in the AM. So this underlying is trading tomorrow on the AM. Citigroup, the chart has been very solid. Let's take a peek at it here. And this is a new high. They've really been a great turnaround story. Market, a little bit of volatility recently going into this earnings report, but there's nothing that really scares you about Citigroup at this point in time. It's one of the lower valued on a PE basis, on a price to book basis. Citigroup is still one of the lower valued stocks in this space. So if we're leaning into earnings on Citigroup, it's a lower price stock. You obviously $11,770 to buy 100 shares of the underlying stock. That's much more feasible than trying to buy 100 shares of Goldman Sachs. So I would treat this one differently. And one of the things that I don't mind doing, because you get a decent risk reward on Citibank, is just look at selling an actual short put spread heading into earnings if you wanted to. And I'm going to modify this quite a bit because I'm not as worried about the, what's the word? Well, I'm just not going to go as wide. I'm not going to take on as much risk, mainly because it's a lower price underlying. The option contracts do better on lower price underlyings as far as bid ask spread is concerned. And also, they're just going to be less pricey on an option trading basis. So, shorter term, they're going to be announcing on tomorrow on the AM before the open. So you have all day today if you wanted to trade this underlying. Once again, a very speculative play, and I always want to emphasize, especially around earnings and these are not meant to be recommendations. These are just ideas that you can apply to your own trading. And if I always go out about 10 days, if I'm doing it just on earnings, not bad. We're getting an 89 as a score. Let's go 5 points wide. We're going to sell the 117. We're going to buy the 112. We're still looking at about a 20 delta there. 91. So you're going 5 points wide and you're bringing in $1.71, right, around the earnings. So 171 divided by 5, that's about 34% of the premium that can be received on this option contract. And I don't mind this trade. I don't mind this trade on Citigroup, just thinking that the stock will at least stay where it's at, which we did see with JP Morgan. We're not quite, the market's not open yet. Let's see what's our indication? Give me 1 second. Let me look over here and see where JP Morgan is at. The S&P 500 futures are basically flat. The VIX is trading right around 15, so showing a little bit of a creep up in the VIX, which I think that could be due with the inflation numbers. And we also got the numbers. Inflation eases as core CPI rises less than forecasted. All right, you would kind of expect the market to react a little bit more positive on that news. But we're seeing all the markets, the Dow, the Russell, the NASDAQ, they're all basically flat at this point in time as far as the futures are concerned. Also seeing gold trade fairly close to flat after this announcement. JP Morgan, let's see where that stock is at right now. In the pre-market, flat. Once everything's flat. JP Morgan down 9 cents right now. After the announcement, they were up about 30 or 40 cents, but basically trading flat on the market. So looking at Citigroup, not a bad trade. Not a bad trade leaning into the trends that we're seeing in the marketplace right now. But obviously, always want to emphasize that if you're trading around earnings, there's no way to know what that earnings report is going to be, and it makes it a little bit more of a speculative type trade. All right. Any other stocks you guys would like me to look at? This is really all that I have at this point in time. Um, Technical ideas, I did want to emphasize that nowadays, if we're looking at some of the underlying stocks, we've done some, I guess, extended research, looking for different patterns on some of the technical ideas. I'd also like to go into the watch list and look for these ideas. So one of if I'm in the financials, I know financials are going to be announcing earnings through here. And I always like to pull it up and see, like, for example, it's highlighting Citigroup in this space, showing that we got a bullish outlook and a bullish outlook here. Relative strength is at 9. You can always use this to try to pick some of the ideas on what financial stocks you might want to do. Another stock that's actually interesting is a lot of the exchanges. The CBOE has had a really nice chart here too, a real nice run up through the marketplace. Right now, actually, I think that's an all-time high. Let's scroll out on the chart here a little bit. Oops, I'm missing my bottom. This isn't the platform I usually use, but going out, this is we got the ducks in a row. You got the 200-day moving average and the 50-day moving average and the 20-day moving average. The 20-day is crossing over to the 50-day moving average. Got 1, 2, 3, 4, 5 straight days of solid bars. They're announcing in February, 24 days away. So quietly, the CBOE has done very well without a lot of fanfare. Still like the stock, and it has a lot to do with volumes. If you do think that option trading is going to continue to set records as far as volumes are concerned, the CBOE is something that you might want to look at heading into that earnings report. Okay, I buy Meta suggested my friend by Meta on Thursday. Now, in terms of options, how would you approach that trade? We projected 650. Okay. So we're looking at Meta, and I guess we're anonymous attendee. We're talking more about uh, just about buying the stock outright, as opposed to looking at an options trade on it. Now, Meta inside the options play platform received bullish trend following signal, kind of hinting that it is right now primed for a shorter term move to the upside. We got earnings coming. I think it's next. Oh, there. I guess I can just look at the earnings date. Yeah, the 28th is when Meta will be announcing earnings. I still think fundamental. It's an AI play. Here's the biggest thing about Meta is Meta's spending a lot of money. And if you think that that's the right thing to do in the AI space, then Meta is something that you'd want to chase after. They just recently did a deal with power companies to make sure that they have the ability to move forward with their AI strategy. So Meta is a very interesting play. If you got the stock right now at 636, we're at 641. You're up about $5 on it. Uh, Projected outlook is 650 on the underlying. I'm not quite sure, Anonymous. Like, how would I have approached that trade if we're going to use options? Is that the ultimate question? Because it is a $600 stock. So Meta is very liquid. So because of that, I wouldn't mind buying deep in the money calls. Now, I don't want to do this around earnings because you are going to be paying up for it. So I'd wait to the earnings report to be I'd wait for the earnings report to come out. If I'm going to trade Meta and I say, okay, I want to get bullish on Meta, and we take the same approach heading into earnings, I would wait a little bit closer to their earnings date, probably the week of. January 28th is what day of the week? That's a Wednesday. So I'd probably look at it on Monday, on the 26th of January. And if we set up something very similar to the Goldman Sachs scenario, we would look at buying a straddle of a vertical around that earnings report. We'd probably put it together on the Monday if they're announcing on the close on Wednesday. So let's look at that trade. We'll modify the trade, hit the bid and ask on here. Let's go 640. Yeah, I guess we could go 20 points wide on this underlying. It's going to be a little bit expensive, so you're going to pay about $1,000. So it would be close to what you're doing on Goldman. So we need to. We'll just do it from here. Would buy the 630 and add a leg here. There it is. Add the leg and sell. We'd go 10 points up and do the 650. And we're a little bit in the money here. You'd rather have it, your others would be that you'd rather be right at 640 than you're equidistant in the money and equidistant out of the money. So this is going to be a little bit more expensive on a true basis. And modify this and trade. It's not bad actually. 630, 640. 8,320. No. 630, 640. Oh, I get the March expiration. That's no. I was like, why is that $8,000? All right, we would go out to the February expiration. Remember, we'd wait till a little closer to the date. I was a little befuddled by that dollar amount. January 28th. Here we go. February 6th. February 6th, you're straddling it, trade it. Yeah, 6,000, that's still too much. 24 days. Oh, that's because we're going 24 days out. Okay. So we would want to wait till we get closer to the day, and 63, 35 and 25, and this should be $10. I think things are getting a little bit screwed up here. So this should be about $10, like I said, because you're buying equidistant in and out of the money. You're only going out 24 days, and it's saying it's $61. Oh, because they're both buys. I got it. That's what I did. Let's do a sell. Okay. $10. There we go. So this is almost perfect in that the time premium, you're a little bit in the money, which is a good thing, right? In that your break even is actually below where where the underlying is trading right now. And that probably has something to do with the fact that we are a little bit further out in time, that we're going out 24 days here. So you have the 630 strike call and the 650 strike call. And if you take 630 plus 1013, you're at 640.13, and the market is at 641.93. So you're getting that same scenario. You're buying just as much time premium as you're selling. As a matter of fact, you're buying a little less time premium because that makes the break even below where the underlying is at. And this is just saying if the stock goes up 10, I'm going to double my money, and if the stock goes down 10, I'm going to lose what I paid for it. That simple. Okay, basically we intraday more. All right, Martin, don't we did an intraday trade? I'm assuming, Martin, right? It did reach 6:45 yesterday and on Friday, and we entered a short-term options call Thursday morning, and it and got out, I guess, near 650. That's all right. It's all right on the trade. Um, Meta, the volatility is coming out from the spend. They have the money, but they are spending a lot of it, and so there's a lot of nervousness on on that fact on the so because of that, there's going to be volatility in the underlying stock. Still has strong fundamentals. They're trading at about a 28 PE. Forward PE, I think, is down around 20. It's still, as far as evaluation is concerned, not a bad trading vehicle at all. We got the bullish trend following. So, Martin, I don't mind getting going back in and buying some more longer term options. But if we're going to apply from anonymous attendee, if we're going to apply the strategy that we looked at Goldman Sachs, I apologize. I had to buy and the sell. I was wondering why it was so expensive. I had a buy and a buy instead of a buy and a sell. But this is normally going to be the case. As long as you go equidistant in and out of the money, you're going to have a break even that's very close to where the underlying stock is at. So you place this trade on, and then ultimately, after the earnings report, it still trades at higher volatility than most of the financial stocks like Goldman Sachs. But then you would come out and look to go deep in the money. Let's get rid of one of these option contracts. Go deeper in the money. Go out. Let's see if they have the June expiration. There you go, 156 days out. Go down to the 80 delta. Now, once again, I would wait until after earnings, and I would look to buy that option contract. And now we're going to be maybe a little bit more. What did we say? It was 14% on Goldman Sachs to get an 80 delta, 156 days out. Now we're at 12. Yeah, we're going to be paying a little bit more in this instance. If we can fill it to midpoint. So $12,175. It's going to cost $12,175 divided by $64,197. We're looking at 19%, and that's just volatility premium. That's the major difference. Now, that will come off a little bit. Goldman Sachs, using the same scenario on a more expensive underlying stock, getting an 80 delta with the June expiration was only 14%. of the amount that it would cost you to buy 100 shares of stock in that instance. Oh, we're seeing JP Morgan bounce a little bit. It's up 270 right now. So it's up 0.75%. I like that for my own trading. I do have a butterfly on JP Morgan, an open wing one, heading into this earnings report. Any other questions? So right now, I don't see, as far as this chart is concerned, this is a gap that you would be targeting, right? This from here all the way up to there, that's the big gap down. But you've seen we've came up and bumped up against it 1, 2, 3 times. So to me, if I'm trading this underlying stock, we got the bullish trend following alert via the options play platform. But if you got a lot going on here. You got the 200-day moving average. I don't want that stupid thing to stop highlighting that. And you got 1, 2. Well, this is the breakdown. Then 1, 2. You got 2 tests. Yeah, if you go back every time that we test this range right here, let's put the cursor. I'd say the 200-day moving average right there, 167, 674.50. That's what we'd call it. Then if we could break up above that in that area, yeah, then that would be a great time to get long some meta at that point in time. And look at this, we got that gap move here. This is an area of congestion, very strong part of the chart through here. And now we're consolidating in that area, and we got the bullish trend following alert. So as far as the fundamentals are, or as far as the technicals are concerned, the stock is looking very interesting at this point in time. All right, I see a couple more questions popped up. I don't know if my computer was slow, but now a bunch of them come out. Thank you as always, appreciate it, Martin. What is the best strategy to hedge my positions on the financial sector? I have far expiration in the money call on JPM. Oh, nice. Still not bad. JPM has done well. I hope you put it on a while back, Oscar. But what would be a strategy to hedge? Okay, if you want to hedge your position, if I'm long call options, we already had the announcement, so that's already over with. And I don't mind selling calls against those positions. I like to wait until the earnings reports, Oscar. So this is a good time to look to do it. If you got that deep in the money call on JPM, let's just look at, and I always want to sacrifice premium as opposed to like owning the stock outright and doing a covered call against it, right? So Tony always likes to aim at the 10 delta. I just don't, that's tough. You got to get a little bit of premium in it. And this is going to be off. Markets are 7 minutes away from opening, but this will be a little bit off because the volatilities will be a little bit high. I can use, I'm just going to look at just the option chain. So let's just modify this. Let's sell it. This would be your short call. Hit the midpoint. Go out either 17 or 24 days. I don't want to make it too nutty. You got earnings coming up on a lot of the different underlying stocks. Goldman Sachs, JP Morgan can affect Goldman Sachs, and Goldman Sachs can affect JP Morgan. Not to mention Citigroup, all the other. So you're going to get some volatility in the space, and that's not what we want. We don't want to get assigned on it. But if you want to hedge the position, let's look at 17 days because it's going to have a lot of premium in it. JP Morgan here. We're going to look at, just literally look at the delta to try to determine it. 230 on the 340, and that's a 23% chance of it reaching that. Okay, so if I owned the stock and I didn't mind, dealing with the fact that it might get called away, this is probably the option I would sell, the 340. But since we don't own the stock, We're looking at 4250 is trading for 160, but that's got vol premium in it, so that's going to come out. You're probably going to look at being able to do the 342.50. That's probably going to be a dollar or so after this earnings report. But just looking at this change, this would be the one I would sell. I don't mind this at all. You're bringing in $1.37 in premium on the midpoint. You're going out 17 days. You're a little bit more than a one standard deviation move away. And that's how I would hedge my long call. I would sell this shorter term out of the money call against it. And I want to make sure I don't get a sign. So you want to have an alert set that if it hits 345, you're going to do something. Don't let it get to 346. Either roll it, close it, you do something if it gets to that range. You don't want to be assigned when you're long a deep in the money call option. And that's a simple little hedge that you can do if you're long option contracts. I don't like buying puts on, if you buy a put on a deep in the money option, you're hedging a hedge, right? Because buying the deep in the money option is already a hedge. It's a hedge for owning the stock outright. You're still, like in our scenario, we're risking 14%. If we bought 100 shares of stock and over a 6-month period in Goldman or in JP Morgan, could we lose 14% on the stock? Yeah, that's very easily. We could do that on, one news report out of Washington, and that could happen. So your deep in the money option contract is already a hedge. So the only real alternative, only way that I like to hedge those deep in the money options is you got to try to battle the time decay. And so the time decay to me, this would actually be called a diagonal. I actually, inside my book, the options playbook, I actually titled it a fig leaf. And why do we call it a fig leaf? Because you're kind of covered. Why are you kind of covered? Because you don't own the stock. You own the right to own the stock, but you got this deep in the money option contract, which makes things complicated because you don't want to exercise it, right? Because once you exercise it, you lose all your time premium. So hence the name the fig leaf, because you're kind of covered. And that name is kind of taken off, actually. All right, anything else? I think that's it, everyone. Market's about to open. Thanks for tuning in. I think Tony's going to be back next week, but he's been very busy with a lot of travel. So hopefully, I hope you don't mind my little twist of talking about strategies. Earnings are always, I always like to trade around earnings. So I think the dynamics and understanding options, earnings is a great time to talk about strategies, even if you don't trade them, because you can learn so much about paper trading around earnings, just about options, just in general. And that's what all these are meant to be, paper trades. All right, my name's Brian Overby. There we go. My name is Brian Overby, Senior Options Strategist at Options Play. My book's called The Options Playbook. Please check me out. Thanks for stopping in.